If you've ever searched for S&P 500 ETFs, you'll know there is a lot to choose from. So in this video, I want to break down some of the best options available to UK investors. I've put together a table of the most competitive choices on the market right now. And the question is, which one of these is the best? Well, first things first, it's worth saying that although they're all designed to track the same index, there are some key differences between them, and a few reasons why you might prefer one over another. So let's go through them by looking at the key factors that matter when choosing an S&P 500 ETF. And as we go, I'll gradually narrow this list down to a final shortlist. Make sure to stick around to the end to find out which one I would invest in and why. Okay, the first factor we need to consider is whether the ETF is accumulating or distributing. A distributing ETF pays out dividends to you in cash, and accumulating ETFs, on the other hand, reinvest those dividends automatically back into the fund. Most providers offer both versions. For example, iShares has two near identical funds, IUSA and CSP1, with the only real difference being one is distributing and the other is accumulating. Same goes for Vanguard's VUSA and VUAG. As a general rule, if you're investing for the long term and you don't need income right now, accumulating ETFs are usually more efficient. You avoid cash drag and everything compounds automatically. If you're looking for passive income or want to reinvest yourself, then distributing funds make more sense. So this gives us a good starting point for narrowing down the list. I'm going to assume most of you watching this are long-term investors. So with that in mind, I'll go ahead and remove the distributing versions. And as you can see, that already cuts the list in half. Now, another thing you might want to take into account, and I know some people do, is how the ETF actually tracks the S&P 500. This is what's known as its replication method, and it tells you how the fund delivers the performance it promises. There are three main methods here: full replication, optimized sampling, and synthetic replication. Let's break those down. Full replication is the most straightforward and transparent method. It means the ETF literally buys all 500 companies in the S&P 500 in the exact same proportions as the index. It's simple, clean, and tends to track the index very closely. Many of the most popular ETFs like CSP1 from iShares, VUAG from Vanguard, or SPX5 from SPDR use full replication. Then we have optimized sampling. This is a form of partial replication. Rather than holding all 500 stocks, the fund holds a carefully chosen subset that aims to mirror the overall behavior of the index. This method can help reduce costs, especially with the smaller, less liquid stocks in the index, but it may cause slightly more tracking error compared to full replication. Now, the third method is synthetic replication. And this is where things get a bit more complex and a bit more controversial. Synthetic ETFs don't actually hold the stocks in the index. Instead, they use a financial contract, often an unfunded swap, to mimic the performance of the index. Basically, the ETF enters into an agreement with a counterparty, usually a big investment bank, that promises to pay the return of the S&P 500. It sounds clever, and it is, but there is a trade-off. While synthetic replication can be very cheap and tax efficient, it comes with a counterparty risk. If the bank providing the swap defaults, you could be left with losses. Although in practice, there are safeguards in place, and defaults are extremely rare. Still, many long-term investors, especially those focused on simplicity and transparency, prefer to avoid synthetic ETFs for peace of mind. If I had to choose purely based on replication method, I would probably lean toward full replication, just because it's straightforward and leaves less room for error. That said, if a partially replicated ETF keeps fees lower and still tracks the index closely, I'm more than happy to go with that. Because at the end of the day, cost tends to matter more than whether it holds all 500 stocks or just a representative sample. So for now, I'm not going to filter the list any further based on replication method. There are still a few important factors to consider first. Now, the next factor that doesn't get talked about enough and that will help us narrow down this list further is the fund domicile. All of the ETFs we've looked at are either domiciled in Ireland or Luxembourg. But what does that actually mean? And why should you care? Well, fund domicile refers to the country in which the ETF is legally registered. This affects things like taxation, regulation, and how dividends are handled, which can have a real impact on your net returns. For UK investors, Irish domiciled ETFs have a clear advantage. Here's why. Ireland has a tax treaty with the United States that reduces withholding tax on dividends from 30% down to 15%. So when an Irish domiciled ETF receives dividends from S&P 500 companies, more of that income stays in the fund, rather than going to the IRS in the US. On the other hand, Luxembourg domiciled ETFs don't benefit from the same tax treaty. So US dividends are taxed at the full 30% withholding rate, which can drag slightly on your total return over time. Now, this might sound like a small difference, and to be fair, it is. But over decades, even a 0.1 or 0.2 annual drag adds up. So if you're investing for the long term and have the option, it often makes sense to prioritize Irish domiciled ETFs, simply because they're more tax efficient for UK investors. With that in mind, I'm going to filter the list further and remove any ETFs that are domiciled in Luxembourg. Now let's talk about fees, because this one actually hits your returns directly. And it's arguably the most important factor. All of these ETFs are tracking the same exact index, so there is no good reason to pay more in fees. The lower the ongoing charge, the more of your returns you keep. SPDR's SPXL ETF stands out here. It has an annual fee of just 0.03%. Another one is Invesco's SPXP at just 0.05% per year. These low-cost options are especially compelling when compared to something like Vanguard's VUSA, which used to be the go-to choice due to its low fee, but now it's not the cheapest anymore. For example, SPXP costs less than half of VUSA, which really makes you think when choosing between them. When it comes to S&P 500 ETFs, I would generally ignore any that charge more than 0.07% per year. The HSBC one already falls outside that range. Plus, it's a pretty small fund, so I'm going to remove it from the list. Now, one thing you might not immediately think about, but it's actually pretty important, is the fund size. This tells you how much money investors have put into it so far. In simple terms, it's like how popular the ETF is. And popularity can matter more than you'd expect. There are three big reasons for that. Larger ETFs tend to have better liquidity, so you can buy and sell with minimal fuss. Then they often have tighter spreads, meaning you lose less to transaction costs. And importantly, they're much less likely to be shut down or merged into another fund. As you can see at the top of the food chain is iShares CSP1. This is by far the biggest S&P 500 ETF available to UK investors, with a staggering £85 billion in assets. That's followed by Vanguard and Invesco's SPXP, which holds over £23 billion. These are giant, well-established funds, and the liquidity you get with them is top tier. After that, the fund sizes start to get smaller as we move down the list. Now, there's nothing inherently wrong with smaller ETFs, especially if they come from a reputable provider. But bigger is usually better. You know they're liquid, trusted, and not going anywhere. You get more trading volume, fewer surprises, and more peace of mind. So I would personally cut out any ETFs smaller than £1 billion, which means this X-Trackers ETF doesn't make the cut. Another thing you might want to consider is how long the ETF has been around. This is known as its inception date. Now, this isn't a deal breaker, especially if the fund comes from a well-established provider, and it doesn't affect how closely the fund tracks the index. But it does give you a sense of how battle-tested the ETF is. Older ETFs tend to have a longer performance track record, more assets under management, and the more established trading history. Now, newer doesn't mean worse. Some accumulating versions were only introduced recently because demand grew. But if I'm comparing two similar ETFs, I usually give a slight edge to the one with more history. It just feels more solid, and there is less guesswork involved. You might have noticed I haven't talked about past performance. That's because all of these ETFs are tracking the same index, so their performance should be nearly identical, apart from small differences due to fees or replication method. So instead of obsessing over past returns, you're better off picking based on cost and structure. Alright, so now we're down to 5 ETFs on the list, and it's time to pick the best one. To narrow it down further, I would revisit the key factors, starting with the replication method. For completeness and optimal tracking, I would remove any ETFs that don't use full replication. That leaves us with 3 strong choices. If fees are the ultimate deciding factor, my personal choice would be SPDR's SPXL, which charges just 0.03% per year. Sure, it's relatively new, launched only 2 years ago, but it comes from a trusted provider and has already attracted significant investor interest. The truth is, any of these ETFs are solid options. The best choice really depends on your personal goals, platform preferences, and investing style. I wouldn't necessarily avoid any of these top 2 if I didn't have access to SPXL. However, what I would avoid are 3 specific types of ETFs that I don't think are suited for long-term investing. So watch this video next to find out what they are and save yourself from costly mistakes that could hurt your returns down the line. See you there.